Next guest is Ashish Shanker, MD and CEO of Motilal Oswal Private Wealth, and he's joining us from the sidelines of the Motilal Oswal Global Investor Conference. He's, of course, attending that conference as one of the investors for, all the client money that he manages. Ashish, great to have you on the show today. So you tell us, the conference also comes at an interesting time when there are so many moving parts, right? US 10-year yields are surging, central banks may not be done raising rates, inflation is high. And the market has started consolidating, the equity market, at least that is. So what are the nuggets or any interesting thoughts you've picked up from the conference? And also, let's break it down into equities first and then fixed income. What is the approach that you're taking to equities now?
Right. Always a pleasure to speak to you, Surbhi, Rima, and Pavitra. You're right. It's interesting times. See, I look at this in two parts. First, the sentiment part. When I meet people in this conference and when we talk to companies, there is a lot of optimism. People are extremely upbeat on fundamentals, earnings. So clearly, the next 3 to 5 years looks very, very exciting for companies in India. And the earnings trajectory also looks pretty solid. So the way I look at this is that, look, even the past has been great for India, but the next 5 years comes with a lot of certainty. And a lot of the rise in markets has also been backed by fundamentals. Just to give you a sense, markets are actually cheaper today than they were in 2021 at similar valuations. So they're about close to 25-30% cheaper. So fundamentals is not a problem. We are still in the reasonably valued zone as far as the Nifty is concerned. I think the run-up has been a little steep in the small and mid-cap segment. So that is where I would tell investors to tread with a bit of caution when it comes to investing. They could adopt a bit of a staggered approach. But when it comes to large caps and when it comes to multi-cap kind of portfolios, I don't think valuations is too much of a worry, given that the next 3 to 5 years are looking pretty solid. As you know, we have frameworks for valuations. We have something called a temperature gauge. It's indicating that we are in a reasonably valued zone. Basically, in terms of investing in equities, we are saying 50% should be done upfront and 50% could be staggered over the next 6 to 9 months, given that there are many events that are likely to unfold. Of course, there is a global backdrop of rising inflation or sticky inflation. And at the same time, you're going into a political season over the next 6 to 8 months.
Ashish, it's good to hear you. And, we haven't had an optimistic voice on the show, I think, in the last 48 hours. So it's good to hear what you're saying, just from a bull's perspective. But I want to run the bear case commentary that we are increasingly hearing past you and get your reaction to that. A lot of the sell-side analysts and, equity strategists that we've been speaking to point out how the Q1 earnings season has been lackluster, the pace of upgrades has been slowing down. We were just speaking to someone who was, from a local brokerage house, who was talking about how margin compression will increase for banks, loan growth will peter off. So suddenly there's a lot of negative commentary after the first quarter. Does that not worry you?
So, look, I think if you take the sell-side community, they're looking at it quarter to quarter, right? Whereas for people like us who manage wealth for customers from a longer-term perspective, we are more looking at it from a 3 to 5 year point of view. So if you look at the earnings from a quarter to quarter point of view, the last 4 years, the earnings rise has been extremely sharp, right? You've almost doubled on the Nifty earnings. So the pace of earnings growth is going to be more steady going forward. More like closer to 13-15% or the long-term average earnings growth. So clearly the expectations on equity portfolios have to be tempered. But, if you take the trade-off between different asset classes and if you have reasonable visibility of getting 12 to 15% as well on equities, I don't think it's a very, very bad outcome. So I think the way to approach it for long-term investors is that the pace of earnings growth will obviously moderate. And hence your expectations from equities going forwards needs to moderate a bit. And if you're worried about near-term volatility, then the best way to tide over this is by having a staggered approach. So for, people who have regular income, obviously SIPs is a great way to create portfolios. But even for larger investors, you could do 50% upfront and maybe a 50% kind of a staggered approach when you're investing. So yes, near term, you may say that the pace of earnings growth has slowed down a bit, but you can't be growing earnings by 30-40% every year, right? So the re-rating or the normalization of earnings has happened post-COVID. That's how I would see it.
Okay, got that. Ashish, thanks for joining us as always. Take us through your outlook on the fixed income side as well. We are in an environment where we have the 10-year yield back at, levels we've not seen in a very, very long time. In that context, how would you look at the fixed income side right now for an investor?
See, the good part is for an investor who's building his or her portfolio today, or somebody who's deploying incremental capital, you have the best of both worlds, right? Equity from an earnings point of view is looking steady, the fundamentals are looking okay, the valuations are not too expensive. Similarly, for fixed income, if you're deploying money at this point in time, the interest rates are pretty interesting, to say the least. And in India, the inflation has not been that sticky. I mean, although the food inflation has been a worry, if you look at the core inflation, that's not been really too much of a worry. So I think, contrasting to the global situation, India inflation, I think, is reasonable. We are used to 5 to 6% kind of inflation. So I would still believe that we are toppish on the interest rates. I don't see another rate hike unless, we have a surprise on the inflation front. So if that's the base case, then, and I'm not calling for interest rates going down in a hurry in the immediate future. So it's a good time to build fixed income portfolios. The only challenge, for people like us in wealth management is that we have to look at post-tax returns. Now, with the taxation benefits going away on pure debt funds, one has to be a little more innovative. So you have these hybrid funds which have a mix of equity and fixed income. Those still offer you long-term tax benefits. So if you're building a portfolio, you need to have a combination of maybe hybrid funds. A lot of HNIs, ultra HNIs are also tilting towards structured debt, and these structured debt products are able to give anywhere between 12 to 18% depending on which kind of product you're investing in. So I would say more work for wealth managers because, we need to not just optimize the returns, but we also need to optimize the post-tax returns. So that's where the investors need to be a little watchful. So hybrid funds, I would say, is the way to go in terms of building larger fixed income portfolios. And yes, for people who can cut out larger checks, there are these structured debt products which can offer you higher yields. So you need to be a little more innovative on the fixed income portfolio, to say the least.
All right, and we have seen hybrid funds also see a big pickup, right? I mean, in the monthly numbers that we get as well, we're only seeing that figure rise. It was at over 12,000 crores this time around. So, Ashish, we would love to have you back on the show to discuss this space in more detail. But, that on another day. We're completely out of time right now. Thank you very much for joining us with that quick take on the equity markets as well as how you would approach fixed income right now. We're going to get into a short break.